Welcome to The Explainer. I am so thrilled you're joining us today. We've got a really focused, incredibly valuable breakdown lined up for you. We're going to take some pretty complex, high-level 2026 macroeconomic forecasts, specifically from Huntington Bank, and we're going to connect them directly to what you're doing on the ground, real, actionable B2B sales strategies for your dealership floor. So, if you're wondering how global currency shifts and domestic labor shortages actually dictate your local equipment sales, and honestly, how to secure those sales in a weird market, you're in exactly the right place. Let's get into it.
Here is our quick roadmap for today's explainer. First, we'll look at the 2026 macro outlook and global trade and currency. Then we'll zoom in on the impacts on commercial sectors. And finally, we'll shift over to the actual solutions, the equipment financing solution and the tangible benefits of vendor financing.
Okay, let's dive right into Section 1, the 2026 macro outlook. To really grasp where we're heading in 2026, we've got to remember that 2025 was basically defined by volatility, right? Shifting priorities, changing trade rules, and a completely unpredictable consumer. But now, forecasters are pointing us toward what they're calling a narrow economy. Now, if you're actively modeling your financing costs, here is the baseline you absolutely need to know. Huntington Commercial Bank is projecting interest rates to drop by 75 to 100 basis points over the coming year. So what does that actually mean? Well, it puts the target Fed funds rate right around that 2.88% to 3.13% range. Basically, a sluggish labor market paired with moderate inflation is paving the way for this easing, which honestly makes fixed rate options look incredibly attractive right now. But check out the stark reality of our modern kind of split down the middle economy. Look at that immense gap in consumer spending growth. We're looking at a massive 24% net increase in spending from households earning over $150,000. But then you contrast that with just a 2% increase for households earning under $40,000. It's wild, right? Spending growth isn't parallel anymore. It is heavily concentrated at the top, mostly driven by the wealth effect from stock market returns. For your business, that means you've got to lean into strategies that actually cater to this totally divided demand pattern. Which brings us to Section 2, global trade and currency. Let's see how this divided domestic situation pairs up with a pretty wild international picture. We are seeing a truly monumental shift here. Back in early 2025, the US dollar literally ended a historic 15-year bull cycle. It depreciated more than 10% just in the first half of the year alone. Investors were essentially diversifying away from US assets because of shifting trade policies and all those inconsistent tariff rollouts. But then look at the Mexican peso. It actually strengthened by nearly 14% year to date. Why? It's heavily benefiting from nearshoring, global supply chains relocating much closer to the US. But hold on, despite all the fears of de-dollarization you might hear about, definitely do not count the dollar out. Huntington Capital Markets actually points out that a return to US exceptionalism is entirely possible. The reason? Massive technological innovations. We're talking specifically about AI. These enhancements are expected to draw major global capital right back into US markets, potentially overpowering all that turbulence from the trade inconsistencies. Moving on to Section 3, impacts on commercial sectors. We've talked rates, wealth gaps, and global currency. So what's the big so what? What does this actually mean for B2B commercial sectors on the ground today? Well, here is a staggering metric for you. The labor supply has, for all intents and purposes, just stopped growing. Thanks to a massive drop in net immigration, plus some domestic workers dropping out of a softening market, the labor force grew by less than 19,000 people per month since April 2025. Because of this stall, the number of new jobs needed just to keep unemployment steady, that break-even rate we look at, well, it plummeted from 250,000 back in 2023 to a mere 50,000 today. And look, these labor shortages, they create immediate real-world friction. When immigration stalls out, specific industries feel an intense squeeze. Take construction, where 29% of the workforce is foreign-born, or transportation, sitting at 21%. They are taking a direct hit. This shortage is even projected to delay the whole recovery of the apartment and multifamily real estate market. So, if you're selling heavy equipment to these sectors, your buyers are currently fighting some incredible operational headwinds. Which leads us perfectly into Section 4, the equipment financing solution. Because if your commercial buyers are dealing with this narrow economy, high costs, and major labor shortages, how do you, as a dealer, survive and actually thrive? The answer is simple. You have to remove their financial friction. And the absolute best strategic tool to pull that off is white label or captive financing. Basically, it's a plug-and-play solution that lets you offer full spectrum financing directly to your customers, but entirely under your own brand name. To the buyers sitting across from you, it looks like your dealership is the one extending the credit. It just creates this incredibly seamless professional purchasing experience. To put this into perspective, take TFS Financial's Dealer Direct Capital platform as a prime example. We know the heavy equipment market is super fragmented, and historically, dealers had to build these financing solutions completely from scratch. It was a total headache. But a platform like this integrates over 50 lending partners right out of the gate. It completely eliminates the need for you to hire in-house finance staff or juggle dozens of lender relationships. You can tailor options perfectly, whether a customer is grabbing a used machine off the lot today or waiting months for a custom order. Let's wrap things up with Section 5, Benefits of Vendor Financing. We're going to zoom all the way down to the sales floor now. What are the actual tangible mechanics of plugging one of these programs into your daily operations? Let's walk through the vendor program approval flow from Memi Financial Group over in Canada. This makes the whole concept super tangible. It's a simple 3-step process. Step 1, your customer fills out a digital application right there at the point of sale. Step 2, the platform shops their profile across a huge network of over 25 lenders to nail down the absolute best approval, usually within just 24 to 48 hours. And step 3, the transaction is funded and you, the vendor, are paid immediately. And honestly, this entire model boils down to one major thing: total peace of mind. There is zero credit risk for you as the vendor. The lender completely absorbs the risk of that loan. You get paid in full the exact moment the equipment is funded, totally regardless of whether that customer ends up making their payments a year down the line. You just get your money and move right along to the next deal. Ultimately, vendor financing gives you a massive, massive edge. It literally turns that dreaded objection of, I can't afford it, into, okay, when can you deliver it? You're looking at higher close rates, higher transaction values because buyers can suddenly afford those premium add-ons, and a drastically faster sales cycle because you aren't waiting around for traditional banks. And crucially, by tapping into specialized non-prime lenders, you can easily salvage deals that your primary bank would have just flat out declined. So I want to leave you with this final provocative thought. We know the 2026 economy is going to be narrow. It's going to be bifurcated. We know your commercial buyers are staring down labor and capital constraints. So how will your business leverage plug-and-play financing to take that exact volatility and turn it into your ultimate competitive advantage? Thank you so much for joining me on this explainer today. Take these insights, plug them right into your floor strategy, and I will see you next time.